Every student needs to see this. 275 years ago, Ben Franklin discovered a secret and was so powerful that he called it the eighth wonder of the world. I'll show how you can use Ben Franklin's secret to get $3 to $6 million in your lifetime, guaranteed. All I ask is that you share this video with a student that you care about. Take action now, and millions are inevitable. Let's dive right in. There are 3 parts to this video. First is the concept, which is the secret that Ben Franklin discovered. Second is the vehicle, which is how you can take the concept and put it into action. Last is the scenario. There are very specific steps that you must take for this to work in proper order, and I have broken it all out for you. Okay, first, the concept, which is the secret Ben Franklin discovered. It's known as compounding. Now, just to give you some evidence of this, if you take a penny, double it for every day, for 30 days, you'll end up with 10.7 million at the end of the 30 days. Crazy, I know. If you don't believe me, take a calculator on your phone, type in 0.01 and multiply it by 2 and hit equals. So at the end of day 1, you're going to end up with 2 cents, 0.02. Now, hit the equal sign 29 more times and you'll see what you get. 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22, 23, 24, 25, 26, 27, 28, 29. Boom. 30. There you go. 10.7 million. Redonkulous. Key thing to remember here. What you're going to see when I show you this visually is the single most important factor for compounding is time. So going back to the penny example that we just did, over 8 million or 75% of the total is earned in the last 2 days. Let's check it out. All right, so this is the penny example that we all just did on our respective calculators. We started out with a penny. At the end of the first day, we end up with 2 cents. But if we continue through day 30, we end up with 10.7 million. But here's the crazy part. From day 28 to 29, we earn about 2.7 million. From day 29 to 30, we earn about 5.4 million. The total for the last 2 days comes out to $8.05 million. And if you look at that as a percentage of the total, that's 75%. 75% of the total amount is earned in the last 2 days, which speaks to the fact that time is the most important factor in compounding. Now, if you invest money and you earn interest on that money, it's broken into 2 pieces. Simple interest, which is interest earned on the original investment, and compound interest, which is the interest earned on interest. That's the magical piece that we're trying to take advantage of. If you're enjoying this, please smash that like button. So now let's go and look at visually what Ben Franklin is talking about with a simple example. Let me explain it. Imagine you have $100 and you're investing it at 10%. At the end of the first year, you're going to have $110. Just take 100 times 1.1. You end up with $110. Now, that $10 is just simple interest. But here's where the magic happens. In the second year, when you invest $110, you have 2 pieces. So you have one piece, which is the $100, which is your original investment. You also have $10, which is the interest that you earned in the first period. So you're going to earn 10% on the 100 or $10. You'll also earn 10% on the $10, which is $1, which is compound interest. So you're going to have 10 of simple and then 1 of compound. But in total, you'll have $20 of simple interest after the first 2 periods, $1 of compound interest. Now, remember that key factor that we talked about, time. Well, ultimately, you have to get to year 15, and what you see is the interest earned on interest, the compound interest, actually outpaces the simple interest, the amount earned on the original investment. This is why time is the most important factor when we talk about compounding. Again, to review, simple interest is interest earned on the original investment, that $100. Compound interest is the interest earned on the interest. In the example we gave, that $10 amount, the 10% we make on that, total interest is simple plus compound interest. Okay, second part that we need here is the vehicle. There's 2 pieces to this. One is the account, the other is the investment. Okay, so we have the account type is what's called a Roth IRA. Now, the Roth IRA requires earned income, which means taxable income. This is money that you earn and pay taxes on. Now, for those of you who are like, oh man, I end up making cash. I did too. I worked as a caddy for 7 years through high school and college, so I know all about the cash game. Now, what you have to do if you make cash is you still have to report it. Now, I know you're like, oh, no, I'm going to have to pay taxes. Relax. The standard deduction in 2024 is $14,600. That means that you'll have $7,000 of gross income. But then once you take the standard deduction minus 14,600, you'll end up with negative 7,600 taxable income. So you won't have to pay taxes on it. Now, the key here for the Roth IRA, again, is the money is post-tax or after tax, which means you will not pay taxes when you take it out. Now, there are income limitations, but these are typically well above what a high school or college worker earns. If you must know, it's $161,000 for a single filer, $240,000 for married filing jointly in 2024. Now, in the high school example, if you're under 18 years of age, you will need a parent, guardian, or custodian to open the account. In the college example, 18 or older, you can open the account on your own. All you're going to need is a photo ID, social security number, and the bank account that you're going to use to fund it. All right. Part two of the vehicle is the investment. Now, in particular, what we're going to talk about here is the S&P 500 Total Return ETF. The cheapest that I've found is Vanguard, which has a 0.03% expense ratio. The ticker symbol is VOO, which stands for Victor, Oscar, Oscar. Now, why are we choosing this particular investment? There's three reasons. Number one, this is the benchmark that professional investors are judged against. And over a 10-year time frame, 98% of professional money managers underperform this benchmark. Number two, it consists of 500 companies across all industries and sectors, so it's very diversified. And number three, the track record. 10.1% total return, which includes prices and dividends over the last 100 years. Really impressive. Third piece to the process is the scenario. So pay very close attention here. I'm going to give you the step-by-step method, and I'll show you the results that we're going to get by following it piece by piece. But right now, just grab a pen, paper, pay attention, write some good notes. Step one, open a Roth IRA. The maximum contribution for 2024 is $7,000. Remember that, because that's the amount that we need to contribute. Now, reminder, if you're in high school, you're going to need a guardian. If you're 18 or older, you could do it on your own. Step number two, you must have taxable income. Now, in the cash example I gave earlier, if you're making regular wage, like minimum wage, that's going to be less than 10 hours per week at $15 minimum wage over the course of the whole year. You'll earn $7,000. You could alternatively say, you know what? I want to focus on my studies, focus on school. I'm going to work during winter break and summer break. That's cool. You could work 40 hours full time for 12 weeks and earn the same amount. Step three, contribute $7,000 to a Roth IRA. Step four, invest the $7,000 in the Vanguard S&P 500 Total Return ETF, ticker symbol VOO, Victor, Oscar, Oscar. Step five, enroll in a DRIP. This is very important. Do not forget this step. DRIP stands for Dividend Reinvestment Plan. This will ensure that dividends are reinvested, which compounds our return. Step six, sit back, wait, let compounding do the work for you. Now, if you want to amplify this strategy, continue investing until you're 65. But even if you stop at the end of college, you'll still end up with $6.1 million. Let's check out the results. Okay, two pieces here. The first piece that we're going to discuss is high school. The second piece that we're going to discuss is college. All right, so in the first case, we're saying that just to go left to right so you understand, we have the current age, then we have the age of retirement, which is typically 65, and then we get N, which is the number of years of investment, which comes out to 52. Now you're like, wait, Ken, 65 minus 14, that's 51. The issue is we're going to invest at the beginning of age 14. So we're going to take advantage of that entire year. So it's actually 65 minus 14 plus 1. 10.1%. That's the average annual return of the S&P 500 Total Return ETF. $7,000 PV, that's the original investment. That's the max amount that we can invest in our Roth IRA in 2024. PMT or payment is zero. We're only making one contribution. We're not making multiple. So then we get the FV or future value at the end of the investment period, 52 years later. So this consists of the rate, 10.1%, the number of periods, 52, the PMT, which ends up being zero, we're not making multiple contributions, and then the original contribution, PV, which is 7,000. Now, the reason why the 7,000 is negative, anytime we have an investment or an outflow, we have to put that as a negative. When we get or receive something as an inflow, it's a positive. That's why the FV is positive. Now, if we continue throughout high school, all 4 years, we end up adding that together, we get $3.6 million. Incredible. Now, if you also continue this process through college, 18 through 21, we get an additional about $2.5 million for a grand total of $6.1 million. Remember, we're investing $7,000 over the course of 8 years, 4 years high school, 4 years college. So that gives us a total invested capital of $56,000. Now, That is a multiple of investment, not a return, a multiple of investment of 109x. So we're not talking about 109%. We're talking about 109 times our original investment. Totally mind-boggling. All right, the wrap up. Don't feel bad if you got started late. Even if you're hearing this and you're starting a summer junior year internship, you're 20 years old, you'll still make 1.1 million at the end of the scenario. You're welcome. When is the best time to plant a tree? 20 years ago. When's the second best time to plant a tree? Today. This investment methodology has been recommended time and again by Warren Buffett, arguably the most successful investor in human history. So we're in good company. It harnesses the power of Ben Franklin's 275-year-old secret, the eighth wonder of the world known as compounding. And you set it and forget it. Let the investment do the work for you. Remember, Roth IRA, 7K, enroll in a drip, let the magic happen. If you enjoyed this video and want to learn about a fascinating tech stock, check out my Palantir video right here. Please share this with someone who you care about to change their life and their financial future. And as always, be relentless.